So to begin with the coverage of our session yesterday, property tax basis and depreciation. Understanding property tax concepts, particularly the basis of property and its implication for depreciation and capital gains. Chris explained how to find historical property costs using Zillow and discussed the importance of basis when preparing tax returns. The group also explored how demolition costs are treated in relation to property basis, concluding that such costs increase the basis of the land where the demolished structure was located. So property tax basis. The tax basis of property is the amount you've invested in it for tax purposes. It's used to determine first, gain or loss when you sell a property. Second is the amount you can depreciate over the time. Then the initial basis includes the purchase price, closing costs, which is the title fees, legal fees, and other expenses or fees that being incurred during the purchase of the property, or improvements such as additions, renovations. Land is not depreciable, but buildings and improvements are. Why depreciate the property and equipment? To recover the cost of business or income producing property, to reduce taxable income over time rather than at once. The significance of depreciation as a tax strategy and reviewed adjustment to basis, including the impact of improvements, repairs, and rehabilitation costs. Where can you find the depreciation in the tax form? It's under Form 4562, depreciation and amortization. It's under Schedule C for business use and Schedule E for rental properties. Moving on, demolition costs and property basis. Before demolition, the land is non-depreciable. Building, depreciable asset, can depreciate it upon demolition. Upon demolition, any demolition expense such as labor, permits, disposal would increase the land basis since they are now part of making the land ready for future use. The remaining book value of the demolished building also becomes part of the land cost. The remaining book value of the demolished building also becomes part of the land cost. Example, the original cost of the land is 100,000. Building being demolished is 200,000. Less the depreciation of 50,000. Remaining building basis is 150,000. Then the demolition cost is 30,000. So we add 100,000 plus 150 plus 30. So the new value of the property is now 280,000. When a building is demolished, it does not exist anymore. And the costs related to the demolition, the remaining building places are added to the land basis because they now become part of the investment in the land itself. Land is not depreciable, so the new total cost will be 280 based on the example. It will remain now the land value of the books. Changes to basis after acquisition, it would increase if you incur the following. So property value tax for capital improvements such as additions, new structure, remodeling, restoration or reconstruction costs, legal fees are related to defending on perfecting ownership, back taxes or assessment paid by the owner, and the demolition costs added to the land basis. What will decrease the value is the depreciation claim or allowable, casualty or theft loss deducted, insurance reimbursement received, easement payment received, partial sale or disposition of part of the property. Basis for property obtained through other means. So 1, property acquired by inheritance. The basis is the fair market value of the property on the death of the owner, or alternative valuation date if chosen by the estate. It is called a step up or step down in basis. Example, if Mr. X bought a land of 50,000 and it's worth 200,000 upon his death, so the basis will be 200,000. And property received as a gift, the basis is the donor's adjusted basis, not the fair market value. However, if the fair market value is less than the donor's basis, there's a special dual basis rule that applies. So you will realize gain for donor's basis or loss based on the fair market value. For example, you will sell the property. Based on our example, the donor's basis is 100,000 and the fair market value is 80,000. If you're going to sell the property in the amount of $90,000, there will be no loss or gain. So property acquired by exchange, it is like-kind exchange. Basis is old properties adjusted basis plus additional cash paid minus cash received. Example, you trade your equipment with 30,000, the adjusted basis, and pay 10,000 cash. The new property basis will be you just add 30 and 10, it becomes 40,000. In like-kind exchange, similar in nature or use po siya dapat. So 1031 exchange basis rules. So 31 exchange definition is that the exchange allows you to defer payment capital gains tax on the sale of investment or business property if you reinvest the proceeds in a similar or like-kind property. And the basis in the new property will be the old property's adjusted basis plus additional cash paid out, boot given, and any cash or property received or boot received. Boot will be the capital gain, I guess, the difference that you gain. For example, adjusted basis of old property is 200,000. The fair market value of the new property is 300,000. You add 100 cash to complete the exchange. So the new basis will be 200 plus 100 is equals to $300,000. If you instead receive cash or boot, that amount would reduce your new basis partially, which will trigger capital gain. So ima-minus mo yung boot. When the taxpayer receives cash or non-like-kind property as part of 1031 exchange, that portion is called boot. So, si boot. Any cash property or property not similar in kind that you received in addition to the new like-kind property. Example, you exchange a property worth 20,000 and you receive cash of 20,000. The boot is the $20,000. In a voluntary conversion, based on 1033, an involuntary conversion happens when property is destroyed, stolen, condemned, or disposed of under threat or condemnation, and the owner receives money or other compensation, such as from insurance proceeds or government payment. It is called involuntary because the owner did not choose to dispose of the property. We also discuss different depreciation methods. They are straight line, the declining balance, the accelerated cost recovery depreciation, makers, and alternative depreciation system. The purpose of Section 280F, depreciation limitation, is it limits the amount of depreciation, including Section 179, expensing, that can be claimed on passenger automobiles, listed property. These are assets that may be used for personal and business purposes. It was enacted to prevent taxpayers from claiming excessive depreciation deductions on high-value personal use assets. Section 179 covers a special tax provision that allows businesses to deduct the full purchase of price of qualifying equipment and software purchase or finance during the tax year. Instead of depreciating the asset over several years, in Section 179, it encouraged small and medium-sized business to invest in them by purchasing need equipment and technology. So the key features in Section 179, so eligibility applies to the tangible personal property like machinery, computers, office furniture, and certain vehicles used for the business. Immediate deduction, you can deduct up to the full purchase price of qualifying property in the year it's placed in service. Annual deduction limit based on 2024 is up to $1,220,000 that can be expensed. Then phase out threshold, the deduction begins to phase out once total equipment purchase exceed $350 million. Business use requirement, the asset must be used more than 50% for business purposes. Bonus depreciation compatibility, Section 179 can be used alongside bonus depreciation for additional write-offs. Key takeaways, Section 179 deduction, immediate tax relief. So it allows business to deduct the entire cost of qualifying property. Then 2025 deduction limit will be up to $120 million that can be expensed for inflation. I'm sorry, may tumatawag. Sorry po.
All right.
Wait lang pa. Then phase out threshold, the threshold is $3,050,000 in total equipment purchases. Taxable income limit, you can only claim the deduction up to the business taxable income. Any excess may be carried forward. Qualifying assets includes new or used tangible property, such as machinery, computers, office equipment, and certain vehicles. Bonus depreciation compatibility, you can use Section 179 as bonus depreciation for greater tax benefits. Strategic planning tool, ideal for small to medium-sized businesses wanting to maximize deduction and manage taxable income efficiently. Then for the amortization spreads the cost of intangible assets like patents, trademarks, goodwill, software, and over their useful life. The purpose is to help match the assets expense with the revenue that generates, ensuring accurate financial reporting. Method use typically uses the straight line method, allocating expense amount each year. Intangible focus, unlike depreciation. For tangible asset, amortization applies only to non-physical assets. No salvage value. Intangible assets are usually amortized to zero. They rarely have resale value at the end of their life. Tax impact, it reduces taxable income by deducting part of the cost annually. Common example of these are organizational costs, copyrights, patents, goodwill. That's all. Thank you.
All right. Can we just give Alma a round of applause, please? I think she put a lot of effort into her presentation, and we can see that, and that's very admirable, Alma. You also set the
Thank
record
you.
or set the bar higher in terms of recap. The same thing with Cherry today. Good job, you guys. Really, really appreciate these kind of initiative. And yeah, just with that, since we're all fresh from the recap of Alma, I feel like you are ready for the game for today. I will just make the announcement a little after the result of the game. I have few right before we start the uh, lesson proper. So let me share my screen right now. So you should be seeing the code already. And the link, I'm pasting it right now in the chat box. Code is 436550. All right, good luck, guys. All right, good job, everybody. The same thing for Section 179, yung 20 year or less lang. Bill, back on top. Last one yan. All right. Congratulations, Adele, Mel, and M. Kilala ko na to si M, mysterious M. Adele, this is your second time to be on top. Good job. Lumalaban. Mel is a familiar name, and so is M. Good job, you guys. Consistent. Kayo. Amazing. Dami niyong magagaling dito. And good job, everybody. So time check 7:38. Let's just update our sheet. So today's top scorer is Adele. So 11,625. Was it Dex playing last time? Good job. So I'm seeing Matt's name and Adele getting repeated here. So yung iba pwede pang humabol. Marami pang chances. All right, then few announcements before we start. If you guys can still see my screen, right? I'm sharing with you the Excel or the G sheet. All right, just making sure that I'm sharing my entire screen. So for the notes and resources, I've added two resources here. For those who want to take on the exercises featuring Schedule C and Schedule E, the resources are in here. There's a Google Drive containing the documents as well as the video tutorial that I recorded via Loop. So if you haven't done the exercise yet, you know, whenever you get the chance, please do so. And then I put here another possible exercise that you can do, featuring section 179 and bonus depreciation. Just play around with the numbers in ProConnect. If you have ProConnect already, or if you have already used ProConnect for some of the, for that simulation that I shared with you just just a few minutes ago, you can add depreciation featuring section 179 and bonus depreciation into that simulated return. Let me just stop sharing my screen and I will reshare again. So just so you get more familiar with how the section 179 bonus depreciation work, right? And then you get more familiar with form 4562 and how you can get the details of your depreciation. So if you have a simulated return in ProConnect, for you to enter an asset, all you gotta do is go to deductions and then go to depreciation. So input the information here and make sure that it's linked towards either a Schedule C or a Schedule E. And then just fill out the necessary fields. And then for section 179, you would need to do some research and check if that asset is qualified for section 179, right? So ang life ba ng asset na yan is 20 year or less. Yung cost, is it covered? So stuff like that. Marami namang resource sa ChatGPT that would tell you if that property is qualified for section 179. So section 179 in ProConnect, you will have to manually input it in here. So you'll have to manually put it in. Say 100% of that can be qualified for section 179 pag hindi niya pa naman na-reach yung limit for that year. So you can put 100% of the section 179 kasi pag wala kayong nilagay, the software will determine naman if qualified siya for bonus depreciation, right? And then after bonus depreciation, kung ang bonus depreciation kasi is 60% of the basis, hindi siya pwedeng 100%. So maximum 60% yung bonus depreciation. And then after the bonus depreciation, only then can you do the regular depreciation kung may balance pa. Okay, so here, if you go to check return, doon sa quiz natin earlier na mention yung form 4562, right? So form 4562, that's this one. But it doesn't give you the detailed calculation, right? It doesn't give you the detailed calculation. If you want to get the detailed calculation for the depreciation, just go here under current year depreciation, regular. You will see the details of the asset, the information as to when it was acquired or put into use in the business, and then how much was the Section 179 depreciation taken. Here, these are the Section 179 depreciation taken. And then kung may bonus depreciation, it's also going to be here. It's called the special depreciation allowance. This is a technical name in the software. Okay, so that's the bonus depreciation. As you can see, my bonus depreciation here was a Ford Expedition, 80,000. Tapos since qualified siya for may limit ng Ford Expedition kasi 6,000 pounds and above siya. So 28,800 lang yung maximum pwedeng i-deduct as Section 179. The rest of that will be basis for special depreciation allowance. This 30,800 is the 60% of the balance of 80,000 less 28,000, right? So 80 minus 28 times 60%, that's your bonus depreciation. And then your current depreciation would be this 20,440, which is now the basis for your regular depreciation, divided by 5. So that's 2,044. And then the rest ay nag full Section 179. Right? So ganyan siya. If you want to play around and you want to see how that impacts your simulated returns, go to form 4562 and then current year depreciation. And then the software will also provide you the next year's depreciation schedule. So as you can see here, wala ng Section 179, right? Only on the first year. And then regular depreciation na siya after. Yeah, so I would advise that for you to again learn the software and the practicality of what we are studying, use your Proconnect to do simulate the returns. Okay? May mali nga lang dito kasi if you take a look at it, 50,000 yung income niya, but the software allows 70,000 deduction sa expenses. It cannot be. Dapat hindi siya 70,000 kasi Section 179 cannot further reduce your loss to less than zero, right? So dapat titingnan nyo to. So i-manual niyo yung calculation ng Section 179. Apparently, ang Proconnect hindi siya ganun pa-smart. Sa ibang software, it may allow you to input the numbers, but it's gonna generate a diagnostic error. So tingnan niyo naman dito sa critical diagnostics, kung may mga mali yung return niyo, it would say here. Pero tiningnan ko to kanina when I was doing simulation, wala akong nakitang related to Section 179. So it's not that smart, you know. But since you know, again, that Section 179 cannot further reduce, then kayo nang bahala mag-adjust doon sa amount na isa Section 179 nyo sa entry doon sa depreciation. You get what I'm saying? Bonus depreciation though, it can reduce further loss to less than zero. Pag bonus depreciation, but again, Section 179 hindi pwede. And then one other thing you need to remember, pwedeng i-combine ang Section 179 at bonus depreciation. Okay, and also if you notice, the IRS actually favors accelerated depreciation. Like early years, ina-allow niyang mag-deduct ng higher amount of depreciation si taxpayer para mas lumaki yung deduction, because if you think about it, their government is supporting mga startup businesses, diba? Pag startup businesses ka, you need working capital, right? To sustain your business. Hindi kagaya sa atin, first year pa lang, ang daming mo nang babayaran, diba? So hindi nagsusurvive yung businesses. Kasi hindi pa nga ini-encourage, wala pang capital access, walang access to capital. Tapos ang dami mo nang binabayarang taxes agad on the first year. You know, on first year wala ka pa namang profit niya because you're still in the you know trial and error phase. But again, in the US setting, they are giving so much leeway sa mga businesses para they can sustain their business. You know, and one way is yung depreciation nga. So that depreciation will allow the taxpayer to not pay any tax during the first few years of the business kasi nag-create yan ng paper losses, right? And those paper losses will allow them to reinvest the cash back into the business. Diba? So, yun yung premise niya. And I wish, we could only wish, that happens to us, right? Like, sino dito nag-business na? I mean, I've experienced that, no? Pag pupunta mo pa lang ng business, ang dami mo ng permit babayaran. So, hindi pa man nagsisimula yung ano mo, tinatax ka na agad ng government, bonggang-bongga. Diba? So, ewan ko na lang. Anyways, enough of that ranting. Let's now proceed. Another announcement for you guys who have not filled out that G sheet that I shared for those mga CPAs na wanting to be part of Carol's database. Please feel free to do so because I gave access to Carol on that so she can look into your profile and see if an opportunity for an internship can actually she can actually provide you an opportunity for either an employment or actually an internship. She's open to internship and then employment, and some others could actually be a direct employment too, right? So just so you are in Carol's network, okay? And then on Saturday, we're meeting her. We're meeting with her 7 p.m. I know yesterday I said it's only going to be for CPAs, but if you guys are interested to join, please feel free to do so. Wag lang kayong medyo ma-offend kapag na-mention ni Carol na CPA. Yun lang yung caveat doon. But you guys are still welcome to join to also understand more the landscape of the US accounting and tax from Carol's perspective. Okay, and then you can also ask questions. Hindi naman kayo tatanong kung CPA kayo or hindi on the spot. It's not gonna work that way. Ang ano lang is that precaution lang or precaution or full disclosure lang is that in her talk she may be mentioning a lot of the word CPA, right? Which may make some of you uncomfortable. Pero kung okay lang naman yun sa inyo, you don't take offense on that, then please feel free to join us on Saturday. Okay? Kasi in a few months, ay maging EA na kayo, di ba? So, it's more than just a CPA, di ba? A lot of you are already thinking of doing EA, so might as well just join, right? Because again, when you become an EA, you're like a CPA na din, right? You're like a US CPA na din. So, okay. Another last announcement. Chris G shared with me an opportunity for training. I shared that in the Telegram channel. Just check that out later. Check their website. As per my understanding, this network provides free training for tax preparation, and then walang bayad, but then they would also teach you to get your own. They will encourage you and probably provide you insights on how to get direct clients, meaning clients na kayo magpe-prepare ng tax return directly, and then they will provide you access to a reviewer. So they will review your work, and then yung filing na rin, e-filing. Kasi alam niyo naman, hindi tayo pwedeng mag-e-file because wala tayong e-fin. So that network most likely has the e-fin access that you can e-file the return. So may cut nga lang sila doon sa pag-file na ng return. But it's very fair because for one, they provide you free training, they provide you review, right? Kasi siyempre accountable na sila doon kasi malamang kanilang bitin at saka IFIN yung gagamitin. And then, wala naman kayong investment. Time lang yung required sa inyo. Right? So, just explore it. They're having sessions every Saturday, if I understood it right. 9 in the morning. So if you can join and, just explore, it could be for you, right? That could be a good opportunity for you to get your feet wet in terms of the actual tax preparation. And then finally, we're finalizing the certification for tax prep. So both individual and business, we're working on that sa Cordless Accountants website. Hopefully that becomes available on Monday, right? So we can start certifying for the tax preparation kasi I really would want to start the internship by December, right? Kasi marami nang pwedeng i-prepare na tax return by December, yung magproforma ng tax return ng 2024 so that for 2025, ready na siya to roll forward na lang sa software ng 2025. And that could be a really good exercise for you to understand the client's situation, right? The client's tax situation, which you may actually help me work in terms of the actual tax preparation by next year. So yeah, abang-abang kayo. Hopefully we can get that done over the weekend so we can launch that on Monday. All right. More details will be provided there very soon. Time check 7:54, so let's get started. Yesterday we stopped at amortization. Let's just continue with the practice quiz.
Jeannie incurred startup costs for her new business, which opened October 1, 2024. The costs were advertising of $1,000, a market analysis survey of $2,500, employee training costs of $6,000.
Chris, I think your sound is not good.
Yeah, I always forget. Thank you, Cherry. Share. All right, guys, let me start over.
Jeannie incurred startup costs for her new business, which opened October 1, 2024. The costs were advertising of $1,000, a market analysis survey of $2,500, employee training costs of $6,000, and travel costs for securing prospective distributions of $2,500. What is the maximum amount of the amortizable costs that may be deducted in 2024? All right, so this is dealing with startup costs. That's what this question is ultimately getting after. And there's an important number that I want you to commit to memory for the startup costs, and that is $5,000. That is the most that can be immediately deducted in a given year. Everything thereafter then has to be amortized over a period of 180 months. So now with that, let's go ahead and think about these amounts that we have here. I'm going to grab our calculator. Trying to shift that right about there. Okay, so we had $1,000 in advertising. So that is part of the startup costs for them before they started generating revenue. Then I had market analysis survey of $2,500. Then I had the employee training of $6,000. And then we had the travel costs of $2,500. So adding those all up, I come up with $12,000. So we have $12,000, but I am going to immediately deduct $5,000, which leaves me with $7,000 to go. This remaining $7,000 has to be amortized over 180 months. So let's go back to our calculator. $7,000 divided by 180 months, and we get $38 and we'll call it 89 cents per month. And how many months did they enjoy the benefit of these expenditures? Well, if it started on October 1st, so we're going to pick up the month of October, November, December, that's 3 months. So let's multiply that times 3. And I come up with $116.68. We'll call it $117, okay? Noticing that our answers do not have any decimal points here. So I have $5,000 which we figured here as we can immediately expense. And I'm going to add to that the $117. So that's $5,117. And sure enough, take a look at that. Our answer is C. You'll notice that B exists, and it's kind of a false positive. Don't get lured in by that and see that knee-jerk reaction of $500. I'll tell you, amongst my students, this piece right here, the extra amount that we need to amortize over the 180 months, is the most commonly missed item. So don't miss that. Make sure you're picking up those months that are there. There's a reason why they're giving you that fact, and the fact pattern started on October 1st. In 2022, Nancy leased a building for use in her business. She signed a 6-year lease with an option for an additional 3 years. In 2024, she made leasehold improvements to the building, costing a total of $8,200. Nancy must, okay, what's Nancy got to do here with these leasehold improvements? Is she going to amortize the improvements over the remaining life? Amortization is generally for intangibles. So A and B are almost immediately out. C, depreciate the improvements using the modified cost recovery system, MAKERS. Or D, deduct the cost of the improvements as a current expense. So is it a long-term benefit, these leasehold improvements for $8,200? Probably, yeah. I'm going to guess that they're going to last a while, considering she moved in 2022, didn't do these for 2 years, and now she decided to make these improvements. So that capital expenditure probably going to last more than just one operating cycle. C is going to be our correct answer. We want to depreciate those improvements over time using MAKERS.
Depletion accounts for the recovery of investment in natural resources property. Let's go over the concepts together. Only a person who has an economic interest in a mineral property is entitled to deductions for depletion. This means the person must acquire by investment an interest in the mineral in place, derive income from the extraction of the mineral, and look to the extracted mineral for the return of capital. So what does it mean to have an economic interest in a mineral property? Well, having an economic interest means you've invested in the mineral property and expect to earn income from extracting the mineral. For example, if you invest in land that contains minerals or in equipment used to extract those minerals, you have an economic interest. The investment could be in land that ensures control over access to the mineral, or in stationary equipment used to extract and produce the mineral and does not necessarily need to be in cash. I absolutely love cost depletion simplicity. It does not matter if it is lumber or oil. The calculation for depletion is always the same mechanically. Take the adjusted basis in the asset and divide that by the estimated total of the natural resource available. That produces the depletion rate. Then simply multiply the depletion rate by the total amount sold to determine the depletion. Alternatively, there is the percentage depletion method. Percentage depletion allows a deduction in excess of the capital investment. It's calculated as the lower of either 50% of the taxable income before depletion, 100% for oil and gas property, or 2, a statutory percentage of gross income from the property, less related rents or royalties paid or incurred. Now, generally, you must use the method that gives the largest deduction. This could be either cost depletion or percentage depletion, depending on which provides the greater benefit. All right, well, that depletes what we wanted to cover here. Thanks for watching.
Mark, a 50% partner in the X and Y partnership, uses the percentage method to compute his depletion allowance for the gas and oil property owned by the partnership. His allowable or his allocable share of the property is $100,000. The fair market value of the property is also $100,000. His taxable income for 2024 equals $65,000. The percentage depletion rate is 15% for natural gas and oil sold. X and Y is a small producer, and the average daily production does not exceed the depletable oil and gas quantity. Mark's share of the gross sale of oil and gas deposits was $30,000. What is Mark's depletion deduction for 2024? Okay, so depletion deductions are actually really fun to come up with because you practically have to be given all of the mechanics to do it. We see the fact that the depletion rate is 15%. And what is it 15% of? Well, it's 15% of the gross sale. In this case, $30,000. So what we're going to do is we're going to take $30,000 and multiply that times 0.15, 15%. So let's grab our calculator. $30,000 times 0.15, and we come up with $4,500. So we got $4,500. And you say to yourself, oh my goodness, that's it? That can't be that easy. Actually, it is. The depletion ones are fairly straightforward. There's a lot of distractors going on in this problem. If the problem was a bit more complex, such as not having this particular fact here with being a small producer, then yes, we would have to go into something deeper. But generally speaking, when you have a small producer and you're given the depletion rate and you have the gross receipts, that's the key information that you want right there. And our computation is pretty straightforward. So A is our answer.
Right. Mas example, ang daming
Which of the
decoration yung
following
question, right?
would not
Napakasimple lang pala ng answer. And anyways, guys, I have not encountered any depletion, so we'll just really breeze through it. It's not very common. This is a good thing to know, and yeah, for those who are planning to take on the EA, it's a good thing to learn. But practically speaking, this is very rare.
Which of the following would not qualify for a depletion deduction? So we've got a gas well, a timber lot, oil refinery, and a stone quarry. And the one that should be sticking out to you like a sore thumb is actually our answer. It's the oil refinery. The gas well, the timber lot, the stone quarry, that's where those raw natural resources come from. The oil refinery is a refinery, not an oil field. A refinery is where the oil is refined into gasoline and specialized oil petroleum products, where we do this transformation. It's manufacturing. It's not where the oil actually comes from. So our correct answer here is C. That is not qualifying for depletion deduction.
There is a lot to consider when selling business property. You must be able to distinguish the type of property being sold before being able to assess how to recognize any gain or loss. So let's dive in and take a deeper look. It is important to understand the difference between gains and losses with respect to how to recognize the gains and, frankly, at what tax brackets. Here are a few things to focus on to have a better understanding of Section 1231, which actually has 3 types of long-term assets and sections used in a trade or business. First up is the pure Section 1231, which is land, and land is not depreciated. Next, we would have Section 1245, which includes personal property and intangibles. The lesser of the gain or accumulated depreciation is recaptured as ordinary income. Any remaining amounts are considered Section 1231 gain and taxed at capital gains rates. There is no recapture when Section 1245 property is sold at a loss. Next, we would have Section 1250 property, which is depreciable real property. The lesser of the recognized gain or accumulated depreciation is called unrecaptured 1250 gain, and that is taxed at a maximum 25% rate. Remember that Section 1245 gain includes personal property and intangibles. Now, consider that while having a business asset such as a vehicle, the asset is depreciated while being used, and that depreciation is used to reduce ordinary income. Because it was a deduction against ordinary income, some of the gain on that sale may be what's called a depreciation recapture. One thing that is important to keep in mind is that the amount of gain does not change. What is changing is how much of the gain is being taxed at ordinary rates and how much, if any, is being taxed at favorable rates. When a gain is determined, the amount of gain up to the amount of accumulated depreciation is taxed as ordinary income. If the gain does not exceed the accumulated depreciation, stop there. If the gain exceeds the amount of accumulated depreciation, any remaining amount is Section 1231 gain. Congress recognizes that gain for asset appreciation is an increase in investment. Therefore, any amount of gain over depreciation receives favorable treatment. There is no depreciation recapture for an asset sold at a loss. Depreciable real property includes properties such as office buildings held more than 1 year and is not subject to Section 1245 depreciation recapture. Instead, under Section 1250, any unrecaptured Section 1250 gain that is a result of depreciation, which is called unrecaptured Section 1250 gain, that's actually taxed at a maximum rate of 25%. When a Section 1250 property is sold, the lesser of the recognized gain or the accumulated depreciation on the asset is taxed at that maximum 25% rate. Any amount over the accumulated depreciation is included in the Section 1231 netting process. After Section 1245 depreciation recapture and Section 1250 unrecaptured gain, any remaining amount is netted together to determine the capital gains. First, the netting process offsets Section 1231 gains with Section 1231 losses. If any Section 1231 losses remain, they may be used to offset unrecaptured Section 1250 gains. When more gains exist than losses, the net gain is long-term capital gain. If more losses exist than gain, the loss is treated as ordinary loss. However, be aware of the Section 1231 look-back rule. Under this rule, in a year a taxpayer has a Section 1231 net gain, they must look back to the past 5 years to see if any Section 1231 net losses were claimed as ordinary losses. Any Section 1231 loss deducted against ordinary income may require some of the current year's net Section 1231 gain to be categorized as ordinary income. Gains realized from sale of property requiring recapture in an installment sale must be recognized in the period of the sale and accounted for by the installment. When property is gifted, Sections 1245 and 1250 do not apply at the time of gift. Any gain realized by the donee upon subsequent disposition, Section 1245 or Section 1250 does apply. Sections 1245 and 1250 do not apply to inherited property unless an exception is met. Exceptions include recognizing Section 1245 and Section 1250 ordinary income at death to the extent of any income in respect of a decedent or IRD, or when Section 1245 ordinary income potentially also results because of depreciation, because depreciation does not pass to the transferee. There is a special transaction called a 351 exchange, which happens when property is exchanged for corporate stock. Section 351 exchanges do not generally have a gain recognition when exchanging property for a new corporation. Section 1245 and Section 1250 ordinary income is limited to the gain from the Section 351 transaction. All right, well, that wraps up the highlights of...
Right. Again, practicality, this, I have not encountered Section 1250, 1245, and 1231. So it's good for EA exam only. The one thing that you would need to remember is That's why we have to keep track of the depreciation, because this can come back when there are these exchanges or where there are disposal of the asset, right? Because when you determine the gain, there could be a factor, the depreciation recapture could be taken into account. So kahit pa the asset, when you look at the section, the depreciation schedule, kahit zero na yan, you still have to carry that forward to the next year. So yung asset, historical cost, the date it was purchased, the accumulated depreciation on that asset, the book value, that still has to be recorded until it is disposed. Okay, so lagi yan. Every time you review a prior year tax return, and may nakita kayong depreciation expense taken on either Schedule C, Schedule E, or if it's a business return, look for the depreciation schedule. Okay, and always ask, kasi minsan the taxpayers, minsan yung mga tax preparers, they do not provide the depreciation schedule as part of the client copy. Kasi ganito yan, when you prepare a tax return, the tax software will enable you to print various copies. Merong preparer review copy, my client copy, and my government copy, right? And minsan, kapag client copy, hindi ina-attach kasi nasa settings yun ng tax software, hindi nakatick mark yung depreciation schedule kapag client copy lang. So, when that client copy is sent to the client, yun yung client, they are, they safe keep that document, and pag nag-change sila ng prepare the following year, whatever copy they have, that's what they will provide the new preparer, yeah, right? And so if you happen to be the new preparer, go through the previous tax returns right away and determine if you have all the attachments in that form. And again, if there are several assets, hindi nyo nakita yung depreciation schedule, itanong nyo na agad sa taxpayer. Hey, taxpayer, I don't seem to see a depreciation schedule. Can you please check if you have a copy of it? If not, can you request from your previous accountants? You see what I mean? Because it's gonna save you time. It's gonna save you time later on when you're actually preparing the return, or your kasi usually mga firms, they would like to pro forma ang tawag dito. They would like to pro forma a tax return from a prior year. So kung ikaw ay nag-work sa isang tax firm, you're assigned a tax return that is new for the year, meaning iba yung prepare last year. So you may have to input the tax return for 2024 para pag-prepare mo ng 2025 na tax year, may comparison kayo. May comparison kayo, right? Kasi ang mga software nagbibigay niya ng 2-year comparison, and it's really good for review as well. Makikita niyo kasi yung change of the income from one year to another. So yeah, it's important that you review the prior year return, and again, if you don't see the depreciation schedule, request for it in advance. Okay? And then meron din minsan, nakikita ko sa mga tax returns, ina-hard code na lang yung depreciation. Like, hard-coded lang, walang breakdown. And we don't want that kasi it's gonna give us a headache later on kapag dinispose nga yung asset. Wala tayong basis. Wala tayong historical basis ng mga depreciation taken. Right. So let's continue.
Depreciation recapture. Thanks for watching.
Maria owns a custom curtain/drapery business. She purchased 3 new sewing machines and, in a separate transaction, sold her 3 old machines for $6,000. She had bought the old machines for $5,000 and had properly claimed depreciation of $3,000. What is the amount and character of Maria's gain? Okay, so on these transactions, what we're trying to figure out is what is the implications of Section 1231, right? And we see that in the possible responses, Section 1231. So we know there's got to be a split between them in some capacity. So the way I like to think about this is kind of like a modified bar chart. If we have the original purchase price of $5,000, and then she depreciates those down to a basis, an adjusted basis of $2,000. And the reason I say $2,000 is because she bought them for $5,000 and she had properly claimed depreciation of $3,000. So this right here is $3,000 of depreciation. So here's the bottom, right? Can't go below zero. So between 0 and 2,000, that is tax-free return of capital, ROC, return of capital. And then between $2,001 and $3,000 up in here, I call that the depreciation recapture zone. And depreciation recapture has to be recognized as ordinary income. Then if we get above this amount, the original purchase price, this is the potential Section 1231 gain area. Okay, so that being said, if she sold them for $6,000, the first $2,000 we're going to take out as tax-free return of capital. So that takes us down to $4,000. Now, from the $4,000, we're going to take the $3,000 of depreciation. So we will subtract that out, which leaves me with $1,000 left, just barely above this line here. All right, so this $1,000 here, right, that's Section 1231 gain for her in this situation. Now, if I go look at my potential answers, I see that C is listed there. I have $3,000 of ordinary gain, and that's my depreciation recapture happening here. And then I have $1,000 of Section 1231 gain. There we go. So,
Right. Kung basic accounting lang to, 4,000 is gain, right? But because this is tax, you have to bifurcate the type of gain, right? Because magkakaiba ang tax rate, right? Pag sinabing ordinary gain, that is tax at the ordinary income bracket nung taxpayer. So kung nasa 30% yung tax bracket ni taxpayer because of the level of income, kasi graduated yung tax rate ng US, the same as in the Philippines, that means a higher tax, right? Ang 1231 naman is like a capital gain, which is long-term and mas lower yung rate niya as opposed to the ordinary income tax rate. So basically, the premise there is just a matter of how much tax is going to be imposed on the gain. Gets? And again, this is not very common, guys.
our answer in this case is C. A taxpayer acquired a rental house several years ago for $190,000. Taxpayer sold his rental house for $190,000 in May of 2024. Under an accelerated method, the taxpayer's depreciation would have been $67,840. Under the straight line method, the taxpayer's depreciation is $64,960. How much Section 1250 gain did this taxpayer have classified as ordinary income when the house was sold? Okay, so the question that we're trying to figure out here is how much of this is going to be ordinary gain. Is it 0? Is it 2880? Is it 64,960? Is it 67,840? Which are the depreciation amounts? A lot of things going on here in this question. Interestingly, the answer on this is 0. And the reason why this is 0 is because any recapture of residential rental property as ordinary income, it's not required because the residential rental property was acquired after 1986. It has to be depreciated using the straight line method. And that ends up being the key here is we are told that the taxpayer, their deduction was $64,960 under the straight line method. So Although we are given the accelerated depreciation, which would have been $67,840, we are told in the fact pattern that they acquired it several years ago. Taxpayers sold the rental property for $190, so you bought and sold it for the same amount, and therefore there can't be any Section 1250 gain as a result. So therefore, our answer here is 0, A.
Makes sense. Come on. Right. So I guess that's for the entire topic on appreciation, right? So that's 7.5. Time check 8:22. We still have time to cover credits. Yung general business credit. So don't worry about depreciation, guys, because again, in real practice, it's pre-calculated. It's already calculated for you by the software. But these are good, good thing to know, to understand how those calculation came about, and familiarity ng mga terminologies. So let's proceed with credits, losses, and additional taxes. How much time does it require? 30 to 5 minutes. I think we can do this. Tapos tomorrow, partnership na tayo.
Business entities may have the opportunity to reduce their tax liability in a variety of ways. In this study unit, we will go through a sampling of the general business credit, which is actually a large umbrella for a wide variety of credits designed to encourage businesses to make certain strategic investments. This could be a credit for offering their employees health insurance, making a building accessible, or even hiring veterans. We'll also look at how to treat a loss year for tax purposes and learn about the classification to either a carry back or a carry forward. And hopefully it never happens to your business, but we'll see the impact of casualty and theft losses from a tax perspective. Last but not least, we'll expand a bit on the flat 21% tax rate for corporations and see that some additional taxes may also apply. Let's get into it. General business credits are business-specific credits that reduce an entity's tax due. The general business credit, often abbreviated GBC, is a combined set of more than 20 credits, mostly non-refundable. Let's dive in to look at the GBC and some of the many credits available through the GBC. On personal tax returns, credits are taken on individual taxes, and the amount of the credit reduces the tax liability dollar for dollar. The GBC is available for small businesses who are sole proprietorships, partnerships, or corporations whose stock is not publicly traded. The average annual gross receipts of the entity for the 3-year tax period preceding the current year cannot exceed a specified amount. For business credits, the credits are combined and are taken as one credit limited to an amount of the tax liability. The GBC for individuals is limited to the net income tax minus the tentative alternative minimum tax, or 25% of net regular tax liability over $25,000, whichever is greater. For corporations, the GBC is limited to net income tax minus 25% of the net income tax in excess of $25,000. Any excess GBC after the limit is applied and may be carried back 1 year and carried forward 20 years. There are a few exceptions to the 1-year carryback rule based on specific credits. Like we mentioned, there are many credits available, but here are a few of the common credits available for the GBC that we typically see in practice. You should review the knowledge transfer outline for more detailed descriptions of each of the credits because they do change from year to year. You should have an understanding of the credits included in the GBC and the rules for each of them. Each individual credit is first determined on separate forms and then carried forward to Form 3800. First, any amount carried forward from prior years is applied before considering the current year credits. All right, well, those are the highlights of the GBC General Business Credit. Thanks for watching.
The general business credit consists of the following credits, except, okay, so which one of these can a business probably not
Training nga to. Best guess. Or I think na bigay naman to kanina. So which one there is not business related?
claim? Investment, pension plan startup, work opportunity credit, or an adoption credit? Last time I checked, a business can't adopt. So the adoption credit is the one that falls out there. The general business credit, which is a really big, broad umbrella for all sorts of different business credits, does include A, B, and C as general business credits. Adoption credit, not one of them. Jones Corporation hired a new employee on March 12th, year one. The new employee has a long-term family assistance recipient and received qualified first-year wages in the amount of $12,000 during year one. An additional $3,500 of wages was earned between January 1 and March 11, year two. What is Jones Corporation's allowable work opportunity credit for year one? Okay, so the magical percentage that you want to keep in mind for the WOTC, sometimes in practice we refer to it as WOTC, the Work Opportunity Tax Credit, or simply Work Opportunity Credit. The magical percentage you want to keep in mind is 40%. 40% of the first $10,000. Okay, so first $10,000 of wages. When we take a look here, it says new employee, first year wages in the amount of $12,000 during year one, and it's asking what is the WOTC for year one. Well, $12,000 is more than the 10, so we're kind of capped at $10,000, and 40% of that, so multiply that times 0.4, we ought to come up with $4,000 as a result. Okay, so the correct answer.
This one, I have not encountered this, but because generally credits are calculated by the software already, but this one is not, because this is more detailed. So one thing that is worth asking for when you're working for a business return is what are the possible credits that the business can qualify for. And this is one of those. But you can only know this if you know, if you're quite involved in the operation of the business, right? So, kasi hindi mo naman alam kung ilan yung hinire nila during that year, right? Or their new hires for that year. So, tip is when you're preparing a return, before you submit that for review, ask yourself, what could be the possible credits that this business can qualify for the year, right? For the year. And this could be one, WOTC. So you may need to ask regarding new hires during that year, right? And there are more credits that were mentioned, yung expenses on yung mga, they need to, yung para sa may mga wheelchair na accessible yung kanilang daanan. If there are expenses related to that, that could also qualify for credit. But the client has to let you know, you know what I mean? Because you would not proactively know about these things. And these are not usually covered in a tax organizer because these are not common. Like that doesn't happen every year. It's not a recurring activity. So again, tip is before you submit your tax return for your reviewer, ask yourself, what could be the possible credits that this client is eligible for so you can reduce the tax, right? And that sets you different from other tax preparers out there. Because in usual tax preparer, they will just, get all the documents based on what were the documents submitted, prepare. After the prepare, submit, right? Not really on the side of preparation and tax planning or tax strategy. So if you want to impress your reviewer or people that you're working with, be proactive. Don't just be the ordinary tax preparer. Always think, how can you save the taxpayer more taxes, right? Or, any tax savings mechanism that you can add, right? That's where you can add value, right? And that's where, you will, again, be very different from all other tax preparers, right? Make sense?
Here is A, $4,000.
By the way, it's a really good interview point. When you're interviewed, always make it a point. Jot down now. What are the things that a firm owner would love to hear? Isa yan, tax strategy. Alam niyo yung mga tax strategies because then, if you know these things, mabawasan yung work ng firm owner. Right? Kasi lagi, ang frustration ng taxpayer when they receive their tax return, kasi sabihin, ang laki naman ng babayaran kong tax. Right? Mag-aayayan sila. Tapos, they would ask, do you think there is a way we can reduce this legally? Right? And that's a really hard question for firm owner to answer because it takes a lot of time for that firm owner to go back to the return, assess possible scenarios that this taxpayer can save money on, right? But if you are someone working for that firm owner, meron na kayong initiative pa lang na before mo na sinubmit sa kanya for review, inalam nyo na, diba? Inalam nyo na kung ano yung possible na tax savings mechanism, and then mag before and after kayo, right? So this was before the tax savings mechanism that you included in the system, and then this is after. So how much you were able to save this taxpayer, right? Again, that would blow the mind of someone when wanting to hire you. Because hindi lahat, again, I've been in tax for 6 years now. Lagi-lagi, yan yung narinig ko sa mga taxpayer. I mean, some of you here who reached out to me asking me for support sa kanilang client can tell, right, that it really is the pain of a lot of taxpayers. Yung parang wala silang control sa kanilang taxes kasi nakikita na lang nila yung tax due nila, malapit na yung deadline, right? Malapit na yung deadline. So when in fact dapat tong tax strategy should have happened during the tax year, di ba? Pero hindi nangyayari yun. As in, bakit hindi nangyayari yun? Kasi mga firm owners busy silang nagpe-prepare ng tax, right? Kasi sila na owner, sila na rin nagpe-prepare ng tax, sila din yung nagfa-file. So wala silang time to evaluate and implement tax strategies sa kanilang mga clients, right? And some of you will listen to the call of a tax strategy I had with, David. That firm, he has clients who are from the Silicon Valley. So employees from Google or Alphabet, Meta, Amazon, and usually when you're employed by these big companies, your pay could be minimum of 500K a year or maybe even 1 million. So these people need tax strategies, not just tax preparers, right? But a lot of them, when I listen to the call recording, their frustration is, you know what, I have a problem with my tax preparer. I only get to speak to that tax preparer once or they don't say tax preparer, they would say accountant. So I only get to speak to my accountant once a year. And every time I speak to him, that's to sign my tax return. I feel frustrated. I feel like a lot of money has been paid to the government. Tapos California pa sila, diba? They pay both federal and state. So yun yung struggle actually, and it's very, very common. So when you go for an interview, that's how you can make a difference, right? That's what can sets you apart to other applicants. When you think of, or when you mention about you're someone who do not just prepare tax. You're someone who understand the tax return of the tax client, and you're someone who can help the client reduce the tax obligation legally by looking or maximizing credits, maximizing allowable deductions. And what are those? Right? So usually clients miss on, sabihin nyo na yan, like usually I notice clients miss on home office deductions, mileage, having their family as employees, self-employment retirement plans, self-employment health insurance, and these are very simple strategies, but these are missed out on, right? Because clients, they don't realize they are qualified to make these deductions. But most of the time, they're already behind, right? Because may mga deadline to mga to, like self-employment, insurance, at saka pension, self-employment pension. These are, may mga deadlines sa mga yan. Pag hindi na implement yan, the year, they lose that credit, right? So if you are knowledgeable about these things, what you can position yourself, pagdating sa interview na, you can position yourself as someone who can partner with the tax firm owner to implement effective tax strategies to clients, so that that firm owner can also charge premium, right? Kasi diba, year after year, mag-evaluate niya ng engagement fee, right? So justifiable kung mag-increase siya ng engagement fee year after year, kasi nakaka-save naman siya ng tax dun sa taxpayer, right? At hindi siya iiwanan ng kanyang client. So you are able to help the firm owner retain the clients that he have, and maybe even add more to it. Kasi he can get referral, right? Like, if you're a really good CPA, you can get referrals from your taxpayer clients. You know what I mean? So bottom line, what I'm saying is that when you go for an interview, which you will do, between now and I don't know when, position yourself. Again, not just an ordinary tax preparer, but you're also someone who can help minimize the taxes of your taxpayer clients by implementing tax strategies. Okay? Simple tax strategies. Hindi naman ganun ka mga high-valuting na tax strategies yun. But later on, if you want to learn more tax strategies, advanced more tax strategies, we will offer that in the community as well. But okay na yung mga na-mention ko earlier, that would already catch the attention of a potential employer, right? You would already set an impression ba na, itong kausap ko, hindi to basta-basta, because he understands things that is usually the pain of taxpayer clients. You know what I'm saying? Okay. Hindi lang kayo basta data entry ba? All right, let's move on to net operating loss.
An NOL, or net operating loss, is a powerful attribute for a company. So let's discuss it. NOLs occur when business expenses exceed business income. In general, NOLs from before 2018 were able to be carried back 2 years and forward 20 years. Then from 2018 through 2020, NOLs may be carried back 5 years and carried forward indefinitely. NOLs from years beginning with 2021 are not allowed to be carried back, but may be carried forward indefinitely. In order to calculate net operating loss, the taxpayer will make adjustments to the taxable income, which should be a negative amount. NOLs from prior years are added back as is any qualified business income deduction or QBI deduction. Then the taxpayer will add back the amount of non-business deductions that exceed non-business income. Next, the taxpayer should make adjustments for capital losses. Capital losses, discussed momentarily, are limited for calculation of the NOL. Capital losses deductible are limited based on characterization of those losses. Generally, a taxpayer may deduct non-business capital losses up to the amount of the non-business capital gains without considering Section 1202 stock or qualified small business stock. If non-business capital losses are more than non-business capital gains, the excess amount may not be deducted. business capital losses are deductible up to the total of the non-business capital gains plus total business capital gains, excluding Section 1202 stock. There are thresholds for how much business losses may be deducted. The rules depend on entity type and the year. The threshold amounts are also adjusted annually for inflation, so be sure to review your GLIME knowledge transfer outline for the current threshold amounts. Now, sometimes it is difficult to distinguish between whether an activity is a hobby or a business. When an activity is deemed a hobby by IRS regulations, the expenses of carrying out the activity may not be deductible. In general, if an activity generates profits in 3 of the last 5 years or 2 of the last 7 years in the case of certain activities related to horses, it is not considered a hobby. Some key things to consider are whether accurate books and records are kept, if the taxpayer intended to make a profit, whether the taxpayer has made a profit in other years, or whether or not the activity is dependent upon for livelihood. This list is not all-inclusive, so for more information, review your GLIME knowledge transfer outline. All right, well, that's it for NOLs. Thanks for watching.
In determining whether an activity is engaged in for profit, the relevant facts and circumstances are taken into account. All of the following may indicate you are carrying on the activity for profit, except, so what's the exception? A, you carry on the activity in a business-like manner. I think that's a great fact, so that one looks okay to me. B, you depend on income from the activity for your livelihood. Also a great fact in the fact pattern. If it's not your primary or a significant part of your livelihood, going to have a harder argument. C, you can expect to make a future profit from the appreciation of assets used in the activity. I think that's another great fact in the circumstances for a business and proving that it's not a hobby, that we have to look at not just 1 year in isolation, but perhaps a broader economic spectrum of that business. How about D? Despite your lack of profitability, you continue to use the same methods of operation to prove that you are serious and the activity is not just a hobby. Well, my friends, as you could probably guess by my inflection in my voice, that's the one that is the exception. If you continue to lack profitability, but you use the same methods over and over, why would you possibly do that? So, makes no sense. D is definitely the exception there. That is not going to help in proving out that you're carrying on an activity for profit and that it's not a hobby. Which of the following is not a modification required to calculate an individual's net operating loss? All right, so what is not required in a modification here? Is it A, add back a net operating loss deduction from any other year used in computing taxable income? That sounds like a reasonable computation requirement for figuring out the current year's net operating loss. You can't consider prior years, so that makes sense. How about B, add back excess non-business capital losses over non-business capital gains? If we're trying to figure out just the true economics of the core business activities for that year, that one also seems to make sense for me. Add back the qualified business income deduction. Now, QBI, right, because qualified business income deduction is QBI, and then the deduction would be QBID. So when we think about QBI, it's kind of a fictitious tax-only deduction. There's no cash going out the door. It's not the true economics of the situation. So as we boil it down, take a look at D, add back all itemized deductions except for casualty and theft losses and state income tax on trade and business income. Now, even if we can't reason through A, B, and C, we ought to be able to look at D and figure out that that is the one that is not required as a modification. And the reason why is because itemized deductions, that's for individuals, not for businesses. So I wouldn't expect that to be a modification to figure out an individual's net operating loss. It doesn't have to do with business. And yes, actually, this is the one that is not required as a modification.
One thing to remember with net operating loss, make sure that you enter those in
Sometimes
the tax software. If it's a new client, right? But if it's like a recurring client, the tax software will already capture those net operating losses, and that will be carried forward to the next tax year. But if it's a new client, again, the same as depreciation, look at the prior year return and check for the applicable forms where you have the carryover net operating losses, and you should input that into the new into your own tax software. Okay? Para hindi mawala, hindi masayang.
Casualty and theft losses may be deducted regardless of whether the loss is business or personal. So let's take a look at those specifics. A casualty is damage, destruction, or loss of property from an unexpected and unusual event. However, special rules apply to deduct casualty losses, so hold on to that thought. Generally, the loss would be claimed in the year the loss is incurred, but there are instances when the loss does not take place in the same year of the actual casualty. A theft occurs when money or property is taken with the intent to remove it from the owner. Similar to casualties, the theft also has special rules for deductibility. Any deductible losses must be reduced by any reimbursements. If any reimbursements are received after deducting a loss, include the extra as income in the year received. Inventory loss may be accounted for in two ways, either by increased cost of goods sold for the period or by a separate loss deduction. If the property is something other than inventory, such as rental property, the loss is either the decrease in fair market value or the adjusted basis, whichever is less. Beginning in 2018 with the Tax Cuts and Jobs Act, or TCJA, casualty and theft losses must be a result of a federally declared disaster to be deductible losses for personal tax purposes. Federally declared disasters must be declared by the President of the United States. When figuring a deduction for a casualty or theft loss, the first question should be whether or not the loss occurred as a result of a federally declared disaster. If it has not, the loss is potentially not deductible. Hopefully you never have to deal with a theft or casualty loss yourself, but at least now you know a bit more about it from a tax perspective. Thanks for watching.
In the current year, Ms. Brown's building was damaged by an earthquake. The building was on land Ms. Brown owned. She used 75% of the building for business purposes and lived in the other 25%. For the current year, her books and records reflect the following. So we've got the information about the building. The ultimate question is, what is Ms. Brown's deductible business casualty loss for the current year? So one of the key considerations that we have to take here is that she uses 75% for business, 25% for personal. So let's break this out into two different buckets. If we take the business and we take personal, and we know that this is 75% and this is 25%, let's start to categorize this out. So for the cost of the building, 75% of $400,000 is $300,000, and the other $100,000, or 25% of the $400,000, is attributable to personal. Now, depreciation should be 100% business. So I'm going to take that out completely out of the business side. We will have nothing over here on the personal side. So 300 minus 130 should give us $170,000, and still $100,000 of adjusted basis for personal purposes. We were then told that the fair market value before the earthquake and after the earthquake, boy, oh boy, look at that drop. That's quite a drop in fair market value. That earthquake did some damage. So let's figure out the total decrease in fair market value, which from $800,000 to $200,000 is $600,000 of decreased fair market value. I'm going to bring that over here as well, and we're going to split that again 75-25 between business and personal. Let's grab our calculator, and you should always double check your math using the calculator, even if you're awesome at math. $600,000 times 0.75, and we come up with $450,000 attributable to the business part. So $450,000 of fair market value reduction and the reciprocal amount of $150,000 attributable to the personal aspect. So now when we take a look at this difference in what's going on here, I'm going to pick the lesser of these two amounts. So I want the lesser of. I want the lesser of either A or B. In this case, it's going to be A for both. That's not always the way that it works out, but it is the way that it works out here in this case. So I want $170,000 and I want $100,000. And you ask yourself, well, why did you pick those numbers? Why lesser of? That's the way the rule's written, and that's the way that we have to break this down. Because she did receive some insurance reimbursement, and we're trying to figure out if there's a deductible business casualty loss here. So for the insurance reimbursement, we again have to do the 75-25 split. So 75% of $200,000 is $150,000. And then the remainder of $50,000 would be attributable to personal. So 170 minus 150 is $20,000. And then I've got 100 minus 50 is $50,000. So the $50,000, I can't do anything with that loss. And the reason I can't do anything with it is because it's personal. But this $20,000 of loss is actually our answer of what we're ultimately trying to determine here. That is the deductible business casualty loss for the current year for Ms. Brown. And again, the reason why is because you are taking this, which is her basis, and we are picking that because it is the lesser of the decrease in fair market value versus her adjusted basis. So she really only had 170 into it, but recouped 150 through the insurance reimbursement, which is why she still has this business casualty loss of $20,000. Our answer is A. Martha owns a grocery store. On October 2nd, 2024, a tornado caused her store's freezers to lose power. As a result of the power outage, $5,000 of frozen food spoiled. Her insurance company reimbursed her $4,000 on December 7th, 2024. In 2024, Martha had a beginning inventory of $10,000, purchases of $8,000, and an ending inventory of $3,000. Which of the following is a proper method to account for this event? So one of the ways I like folks to think about these types of situations is pretend as if the insurance company, instead of reimbursed, think of it as they bought. They bought a bunch of spoiled food for $4,000. So if we think about it that way, one of the things that she could do kind of pops out to us in option A, which is to report the $4,000 as additional gross income and just track her inventory as she normally would. She could take these out of inventory, take the spoiled inventory out, and not have to really mess around with the somewhat more complex calculation of inventory. So A is a really good, strong item. B, do the same thing, but exclude the $4,000 from gross income? That doesn't seem right, and it's definitely not. So it's definitely not B. C, reduce beginning inventory by $5,000 for 2024 and deduct a $1,000 loss on her 2025 return. Well, it seems there that you're reducing inventory and then you're taking a deduction. And it's not that the beginning inventory was impacted because this tornado happened on October 2nd, 2024. So just tracing the numbers, C doesn't make sense either. D, reduce purchases by $5,000 for 2024 and deduct a $1,000 loss on her 2025 tax return. She still had the cash flow going out for the $5,000 of spoiled food. So and we see that here, right? The $5,000 of spoiled food. It's not that she had less purchases. We're actually taking a deduction out if we do D. So yes, our answer definitely is A. She would just report the inventory as normal, take the write-off within her inventory for the spoilage within that food, but then pretend, like I said, as if the insurance company bought the spoiled food for $4,000, because that's kind of what happened. So our correct answer here is A.
Alrighty. Time check. It is 8:57. So let's wrap it up. And remaining item is additional taxes. There's not a lot in here. After additional taxes, we are heading to start with partnerships. So tomorrow we can already start partnership, and there's how many topics for partnership? Three topics, and then corporation, 1, 2, 3, 4, 5 for C Corp, and then S Corp. When we go with S Corp after partnership, only because it's most common. S Corp is most common, and the next is partnership, and then very few lang then yung na-encounter ko na C Corp returns. Usually kasi pag C Corp, hinahawakan na ng malalaking firms, and they're usually hindi ina-outsource. So, yung na-handle natin mga C Corp, maliliit lang din. Right? So, pag C Corp kasi, may iba sa kanila, mga listed na mga companies. So, yeah. So, that's the goal. Partnership, then S Corp, and then isunod natin yung C Corp, and then mga exempt organizations and trust, mga 1041s. All right. So, 8:58, sino nag-open ng prayer kanina? Si Alma, no? Alma, do you mind closing today's session with another prayer, please?
So let us put ourselves in the presence of God. Lord, may everything we discuss and plan bear fruit in your perfect time. Help us carry forward the spirit of excellence, dedication, and unity in all that we do. As we end this session, we ask for your continued guidance and protection. Bless each one of us as we return to our task. May we be channels of positivity, integrity, and service wherever we go. All this we ask in Jesus' name. Amen.
Amen. Thank you, Alma. Thank you guys for today.
Welcome pa.
I'll see you guys again tomorrow. Same time, same channel.
Thank you, Chris.
Thank you,
A
Chris.
pleasure. Bye-bye.
Thank you.
Thank you. Good night.
Good night.